Yeah, I mean, it's great to hear that there's consensus. I haven't quite heard Andrew say it, but I think we all
Hey, you got
believe.
to ask him. You got to give him a
Andrew,
chance,
is it the
just in
customer's
case.
data? I'll take the
So I would
moderator.
say, Dan, that no. I'm in 100% alignment. I mean, last year we launched something called the Data Responsibility Imperative. You can go find it on our website, where we made it clear that the consumer owns their data, the consumer controls it, the consumer should have choice. Look, we've been dealing with GDPR. We're a global company, and so we've gotten very used to, over a good number of years, the legal concept of consumers owning their data, full stop. There's no question about that in Europe. To us, it's a little fascinating, I would say, that there's still potentially a debate in the United States about that the consumers own their own data. But I would say, from a MasterCard perspective, that is not at all in question. And I would also say, having been in many industry conversations at FDX, which is, for those who don't know, Financial Data Exchange, which is the standard setting body in open banking at which a lot of fintechs and the big banks participate, it has become clear that the banks themselves also agree with that position. I think some of what Suzanne was just expressing were the concerns that are not about ownership, but about transparency to the consumer as to what's going on with the consumer's data. Because in many cases, we understand that the consumer doesn't understand what's going on with their data. And if they don't understand it, how are they controlling it and how are they owning it?
Yeah, I think the transparency piece is something where we really do strive to be a leader. We have launched products such as Plaid Exchange, which was released last week, where consumers can actually go and view and manage their data across multiple financial institutions, request its deletion, which ties in, again, Andrew, to some of the regulatory issues that are both in the US, but even more so globally. Plaid, we're a regulated entity in Europe under PSD2. And in Europe, it's actually explicit in the law that financial institutions have to share their data. And then if you look at countries that have come along a little more recently, like Australia, they actually have a general consumer data right, which goes a step further and says, not just do financial institutions and other guardians, to borrow Suzanne's language, of the data, which I think is exactly the right term. You have to protect it. And when we have consumer data, we have to protect it. That is both a legal, moral imperative. But there is this concern, which the Australian rule, I think, does a really nice job balancing, of protection versus anti-competitive behavior, because we are talking about financial services. If I have a credit card loan, my competitor may want to know what my credit card interest rate is, say 15%, and offer me a 12% rate. Now that would be a win for the insurgent. It would be a win for the consumer, but it would be a loss for the incumbent. And I think institutions need to understand that there is a competitive market out there, and consumers should be able to easily and transparently share their data, because it's going to make financial services better. We see this in the mortgage space. It used to be the most paper-heavy process, hundreds and hundreds of pages of documentation. But if consumers can opt in with, a very few screens, a process that takes less than 1 or 2 minutes to share their data, a lot of that information can be processed electronically and in real time. It's going to save consumers a massive amount of back and forth. And over time, it's actually going to save banks a lot of overhead on processing. So it really can be a win-win-win, but institutions have to view it that way.
Yeah, I think those are good points. And one of them, to just explore a little further, the concept of protecting the user's data, right? How do you balance both operationally and just from a business standpoint, protecting the data from allowing the customers to have control of the data, right? And I think specifically of some of the legislation in Europe where, the banks are required to make the data available. Okay, that's great, right? Good for the customer, whatever. But they don't say how or how it's secured or how to ensure where liability lies if the data is used in a bad way. And I know a lot of that's advanced and there's more and more thought being put around that. But the kind of fundamental question is, if you know, Plaid as an example is a platform to allow third parties access to you know, we'll also say it differently to make sure I don't say it in error, to allow the customer to access their data in a third party platform. I'll say it that way. How do you, like, who has the responsibility of ensuring that that platform treats the data the right way, right? And I think that to me is just historically one of the friction points in this conversation a lot of times between financial institutions and those that are working to make the data available in different ways, is that, you know, if the bank is the steward, or views themselves as the steward of the data, even acknowledging it's the customer's data, how do they do that and also allow it to be in the world? Like where do we insert, whether it's controls or criteria or guidelines to help influence that?
Yeah, so I mean, I'll just speak for the Plaid side of it. One is that, you know, absolutely what you said is right. Like, we actually help consumers to share their own data on an opt-in basis. So the key thing is there that you only share the data with the person that the consumer has directed it to. I think anything that involves third-party sales of data, selling data to hedge funds, that's always been off the table for us. And it's something that's a legacy bad practice in the industry. The second thing that you mentioned is like, what are your responsibilities as somebody who's enabling this? And we take those very seriously in terms of vetting who our customers are, what data they have access to, and then managing risk proportionately. So if you just look at our customer set, you have folks like Square Cash, Clarity Money, Varo. These were all small companies when they started using Plaid, but a number of them are either publicly traded now, or they're part of regulated financial institutions because they've been acquired, or they're actually planning to transform themselves into deposit-taking FDIC-insured institutions. And so, you know, what we'll see is that over time, the partners of ours that have the most data deserve to have the most scrutiny. And that's the same as us working with the banks. Like, as one of the bigger players in the space, we know that when we talk to a Chase or a Wells Fargo or a US bank, that they're going to spend more time with us focusing on our practices. And it is our responsibility to both inform them and demonstrate that our controls at an information security, compliance, and how we do everything really is up to snuff. That is a huge focus as a company. And we have the fortunate position of building, you know, from scratch since 2012. So we're a younger company. We have very clean infrastructure, and everything that we've built has security in mind, which is why, you know, every time we host a bank for an on-site audit, they always walk away understanding, okay, here's what Plaid's doing to protect data for individual users, encryption, in transit, at rest, and then everything else that goes beyond that in terms of actually making it operational for the entire company. So those things are super important, as you said, Scott.
Yeah, Suzanne, what's your perspective on this one?
Yeah, so I don't disagree with everything that Dan is saying. It's very, very important. And to his point, we do put a big emphasis on InfoSec and the auditing side of things. Contractually, we're very focused with the aggregators and the fintech communities to ensure that we stipulate in a contractual manner what our expectations are. But then secondly, we seek standards. We look for best-in-class standards to be the standard implementation structure of a solution that we integrate with an aggregator or fintech. And we also seek to enable a standard across the ecosystem. And that's why we're board members in the Clearinghouse and FDX and other bodies that are working together to establish a common standard that pushes the envelope with regard to customer experience expectations, as well as an interoperable environment where we can all benefit, but also ensuring that we are anticipating and thinking through where are the new cyber risks going to occur and how do we mitigate against those, because that is a huge concern. You know, data is, as I said, and we both all have said at the beginning, is really the new gold, it's the new oil. It's so valuable. So it's essential that we ensure not only is there best-in-class standards and security between the bank and the partner, but also throughout the entire ecosystem, and that we're working together to ensure that that's in place.
So Andrew, that's all great, right? That's preventative, that's happy path, that's how we keep things from going wrong. What about when something goes wrong? What's your perspective on who's accountable to the consumer, right? Is the bank, because they let the data, whether the customer asked for it or not, they allowed the data to go out into the world? Is it Plaid because they facilitated that interaction with a third party, or is it the third party that now disappeared or got sued into oblivion, so there's not much good it does being mad at them anyway?
So I would say there are probably multiple answers to that question, and let me parse it apart. I mean, I think there is a concern from the banking side that the regulations, no matter what, still impose certain liabilities onto the banks, no matter what they do contractually. So I would say that is just a regulatory concern in the United States. The other piece, though, I would say just from a belief standpoint, if somebody has bad security, they should be liable for the consequences of their bad security. And generally speaking, I would say the templated agreements that we've seen, and if you look at the TCH's templated agreement, they try to put the liability on the party where the responsibility falls. So I would say that is where the industry is moving. It's just, I don't know that the regulations have caught up to it. However, we do know CFPB is on listening tours, and so curious where they're going to come out on this as far as that goes. So depends who you ask what that answer is.
Yeah, that's one of the challenges there, just building on what Andrew said, is that there are over 10,000 deposit-taking institutions in the US when you look across the banks, credit unions, investment firms. And so one of the challenges is if you say all of the third parties are going to be responsible, you might have to have 10,000 different actions depending on how many banks are sharing data. And so one of the things we take really seriously at Plaid is making sure that when we work with the banks, we say, this is going to be proportionate based on the amount of data, the risk is going to be shared, and the consequences are exactly that. They're going to fall on the party who's responsible. But then we go even a step further, which is we as a company need to be doing serious vetting of our customers and understand, you know, at the small level, there's a lot of innovators, and we don't want to stamp down innovation and say that every company has to have a CISO when they're two people and they're just developing an app concept. We need to find a way to keep those developers innovating and pushing the boundaries, because a lot of the best ideas have come from smaller developers. At the same time, once you get bigger, some of those customers I mentioned earlier, you want to be able to share responsibility and have people very seriously take responsibility and take guardianship of data seriously. So that's the balance and trade-off that we're talking about. I think, you know, just in the industry in general, one of the things that sometimes becomes apparent is that there's a few big banks and they do have a massive share, but then there's all these consumers, including myself, that bank at smaller institutions. And it's really important to make sure that whatever we're designing, we're not leaving those behind. I grew up in the Boston area and I still have an account at East Cambridge Savings Bank. And it shouldn't be the case that I can't use that bank to opt into data sharing, but I can use, you know, my big bank account, as much as I love my big bank account and my big bank credit card as well.
So Dan, what does vetting look like? Like I imagine it's a fairly robust process, so I'm not asking like down to the in detail, but like what are some of the, and Suzanne, I'll ask you as well, but like what are some of the major things that you feel like are key signals of trust or stability, or you just generically, right? When you're vetting a new partner, what are the big things?
I think if you're going to be scalable, and then I'll let Suzanne go. If you're going to be scalable, you have to apply technology to the problem. So, you know, you have to do all of the standard like AML, KYC checks that would be done at a financial institution. I used to work at a bank, so I'm pretty familiar with the computer-based trainings and everything that goes into that. But at the same time, you have to figure out how to do it in a scalable and automatable way so that the only people that you're doing extra investigation on are exceptions, people who come back with data missing or some type of inconclusive or bad record, as opposed to, you know, setting the standard in such a way that the default is going to be no, and you're not going to enable innovation. And then you're only going to let, you know, let's say the big players, the folks with the chief information security officer through.
Suzanne, do you have an opinion on this one?
Yeah, I have an opinion on most things here. So yeah, you know, everything that Dan is saying, technology is correct. One of the things that we focus on is, as I said earlier, implementing a standard. So we want to take credentials out of the system. That's a big, big risk. And we're on a big path right now with all the aggregators to take credentials out. All the rigor that we're talking about here in terms of standard OAuth practices or app-to-app experiences or other CISO, you know, InfoSec standards, those are all table stakes, and we look to the aggregators and fintechs to be able to work with us to implement those. But one of the biggest things that we have to do as an industry is take the credentials out. And we've struck deals with all the large aggregators and fintechs in the country to enable that. Taking credentials out and replacing them with a more secure means of providing that data transfer in a read-only manner is going to be a huge impact and positive impact to the customer and to the ecosystem as a whole. And so the more that we can do that as an organization, a set of organizations, and the sooner we can do it, the better. And we are advocating strongly that you know, us as a large bank and other banks who are partnered with us in this effort do so as quickly as possible with our, you know, aggregator and fintech organizations.
That makes sense. And I think figuring out that right balance is key, right? Of both enabling that to occur and doing it in a way that scales, because that becomes the challenge to some degree. And I think the pathway of using, you know, aggregators and other third parties that are kind of consolidators of connection is a good way to do that. To change gears a little bit, so I'm going to ask a question that got asked from our audience. So I'll let our audience know. I try to give our participants a fair chance here with audience questions, because sometimes you know, not everyone's comfortable, or their companies don't allow them to kind of dive into certain areas. So I like to let people opt in. So I'll queue this one up, and if someone has an answer they want to throw out there, then great. If not, I can add my perspective. But we had a question from the audience around the economics of open banking. And I know this is something that a lot of the banks we work with, a lot of the third parties we work with struggle a little bit in trying to figure out, like, what is the right approach to this? And basically just point of view around, you know, things can't exist without the paying for them, basically, right? Like, you build a service that takes developers, that takes energy, that takes business people working to build something, and that incurs cost. You know, often for coming from the bank side, I spent 15 years working at 2 big banks. Like, you very rarely develop product where you don't have some sort of cost model for, where you can show how it's going to generate revenue and or the cost savings it's going to create. How do you all view the economics around open banking? Is this something ultimately that customers, whether it's segments of customers, like say we get into small business or another segment where models exist, that they ultimately need to pay for? Is it something the banks need to just offer as a service because it's table stakes and it's no different than mobile check deposit, right? Like, that costs money to develop. There's no revenue off of that. That's just what your table stakes of being a bank and offering good service. Or is it third parties that want access to that service, and they're enabling an experience that in theory they build a revenue model off of, and so they've monetized that experience leveraging some of the bank's information or some of the user's information that's provided by the bank. I have to choose words really carefully here. And are they the ones that should you know, maybe create that economic incentive? Again, no expectation that you all answer, but would love to hear from any of you willing to speak up.
Yeah,
Well, I'll jump.
go ahead, Suzanne.
Look at there.
No,
I got 3 winners.
On you before, so you go first. I mean, if I disagree at all.
Okay. So I think it's a multi-pronged answer. I think, first of all, it's the right thing to do. So we have to, as I said earlier, we need to ensure that this data that is our customers, we as the custodian of that customer's data need to ensure that we're raising the bar and enabling them to have a more secure way of sharing that data in order to have the relationship with the financial institutions and others that they want. So it's the right thing to do. With that comes a risk mitigation plan. So you take credentials out of the system, you therefore take some of the risk that's going to be borne by the banks from at the threat of a breach. That is eliminated as well. And then with anything, when you open up your environment, you create a new opportunity for value to be developed and created. And if you look at overseas in Europe and Southeast Asia and other parts of the world where open banking has been more established and driven from a regulatory perspective, those countries and the organizations within them have found ways of driving value for all the participants. And so I don't shy away from the fact that, yes, there might be a cost associated for us to invest in this, but like anything, once you open up your environment and you introduce the opportunity for the sharing of information in a unified manner, then you open up opportunities to create net new value and benefits to all involved. So it's going to take some creativity, but I definitely think there's opportunity for those who wish to put the effort in.
Yeah, I love that answer, Suzanne. And
thank you.
I can't really disagree with much there. I would just say, again, going back to the value for consumers, like you could imagine a bank in 2020 still not offering online banking and mobile banking. They would save a lot of money. They could do everything on paper, but they would not be competitive, right? So there's a lot of things that both financial institutions and technology companies need to invest in ahead of the financial returns coming, because what you're really doing is you're making the market more efficient, you're better serving your consumers, and over the long run, that's going to generate returns, not necessarily just pure cost savings or cost shifting.
Andrew, anything to add? You look like you were going to jump in and say something too.
Well, so yeah, no, so I was going to say this topic actually is a subject of research by the British regulators at this point, because the British push to get the APIs opened up from the financial institutions, and they are the two limited API, I would call limited, the two APIs for specific purposes at specific institutions. So for example, they don't really include DDAs or savings accounts. And so as they're looking to open up the system more, they're realizing they somehow need to incentivize financial institutions to participate, because they weren't participating as fast as they might otherwise like. The stability of the APIs, there's no incentive for the banks to make them more stable. And so they are realizing, oh, we need to somehow not just make this as a cost onto the banks, we need to make this somehow a win-win for the banks. And so I think the dialogue is an ongoing dialogue, and there are a lot of different positions coming out there. And I think this is actually, even the British regulators are sitting there going, maybe that we're going to let the market decide this, to determine how do we get the best services, because I think best services with the consumers will wind up winning, right? And so there is that piece of this as well, not just from the data availability side.
Yeah, fully agree. It's interesting, this topic in general is one that varies differently from region to region, both obviously in terms of the regulatory impact, but also just in terms of how I think financial institutions and other players view those dynamics based off of just, years and years of different market dynamics as to where, where things have developed and kind of who controls a certain piece of things or influences a piece of things. So that worldview is helpful as well. So we talked a little bit about standards earlier. Let's jump back to that. So Suzanne, you mentioned FDX. Just for those of the viewers that aren't familiar with FDX, can you give a real quick overview of what FDX is and kind of the goal of FDX?
Sure. So I apologize if my video keeps flipping back and forth. I don't know if I'm going off and on, but anyway. the FDX organization is a consortium. It represents the Financial Data Exchange, and its objective really was to create a standard, an interoperable standard that could be used across all participants in the data sharing ecosystem or environment. So you have fintechs, you have aggregators, you've got financial institutions and others that are both now here in the States and also up in Canada. Canada is a participant as well now. So you have this North American collaborative environment that is looking at establishing standards with regard to the API design and the data elements that are going to be shared through that API, as well as the consumer education aspect of things and other tangential aspects of this whole ecosystem. Such, you earlier mentioned about how do we vet and control and evaluate the participants in this world. And one of those is through a third-party risk management exercise. And so that's another area that FDX is focused in on too, as well as the Clearinghouse Connected Banking Group. How do we establish a standard with regard to evaluating and vetting all of the players in this ecosystem to ensure that everybody is meeting the standards and able to operate in an open manner? Akoya is another organization that we haven't mentioned here on the call, but that's a new platform solution that's also entered into the industry in the last couple of months. And its whole purpose, it's primarily at the moment co-owned by a number of, I think about 11 financial institutions, but that will evolve over time. But its purpose really is to create that transparency and openness across the whole of the states with regard to data sharing. And so when you mentioned a couple of minutes ago about the smaller banks and what it takes for them to participate in this, the whole objective here is that we will, as leaders in the industry, so the large fintechs, the large aggregators, the large banks who've already invested a lot of money, it's more of an egalitarian approach. We're going to load all of that into an ecosystem that is going to fuel the sharing of data and the standard API set for the smaller banks to be able to tap in at less cost and benefit from all of the work that all of us have invested in so far. So that organization will be using the FDX standards as well. So FDX is critical as a standards body that's self-regulating really for this industry.
That's great. And I appreciate you hitting Akoya as well. I feel like we could have a whole nother session just about that and some of the dynamic around that. But unfortunately, we're about to run out of time. So Andrew, Dan, and Suzanne as well, I want to give you a chance. Any final closing thoughts or ideas before we close out today?
I mean, I just love the idea that Suzanne mentioned at the end around enabling all of the financial institutions to participate and all of the players in the ecosystem. I think if you look at the past 5 or 6 years, a lot of the innovation was driven from the outside in, more from the fintechs and the aggregators really forcing banks to open up. The fact that we have banks building their own initiatives and saying, we actually think this is valuable and we want to compete and build things on our own is really great. We are also members of FDX and we love standards. We think that over time, the industry will move to standards, but there has to be a push to also say, what is a better user experience over time? What is more value creation? Because the problem with consortia, as Suzanne well knows, is you have to get consensus from all these different competing interests. And sometimes that is going to be a slow process and it's going to be a little bit behind what the cutting edge state of the art industry is. And so we developed a product called Plaid Exchange recently. The idea there is really to have something that is easy to implement for the long tail of smaller financial institutions and fintechs, has some of the newer technology, but we're also bringing all of that new technology into the FDX consortium and pushing the consortium to say, hey, if real-time transaction data should be available in 2020, why are we still polling? Like, we can do these things, but to do them in the consortium just takes more time. And so we're dually engaged. We're on both tracks there. It's
Andrew,
a lot of work.
Final word?
I would just echo Suzanne's support of FDX and just say I think this is just a great opportunity for consumers.
All right, Andrew, you
awesome.
You videoed out. You helped Rami out because he was ready to go. So your video saved the day today for Rami. Hey, I just a real quick thank you, everyone. Appreciate all the conversation. Like I said, a ton more we could talk about, but appreciate all the good dialogue, and thank you all for being here today.
Thank you.
Thanks, Scott. Thanks, everybody.
Absolutely.
Thank you.
Thanks again, and Scott, great job hosting. Just a couple reminders for folks. We've got a couple more minutes to answer the Slido questions for the beta certification if you haven't already. And we'll also be needing to change to a different stream for the next 2 sessions that are running simultaneously. So you can choose from the Fintech session that is on mergers and consolidations, or the InsurTech track session, which is on the innovation of digital ecosystems and InsurTech. Thanks again for joining. Everyone really enjoyed it. And as Honeyfi is a consumer of open data, we're really eager to see the future as well. So thank you to everyone for listening, and take care.